Today, we're going to have a really exciting discussion on really focusing on the RightCapital tax estimate module, which features a lot of samples of the 1040 mock-up. For each year, we have various schedules we're going to be going over, alternative minimum tax schedules and the taxable Social Security form. So there's no shortage of schedules and forms we're going to be looking at today. And all these can be leveraged to garner further insights on how taxes are being calculated within RightCapital, and to just help gain a deeper understanding of the comprehensive tax calculations that happen within the system. This is a favorite topic of mine, as expenses and specifically taxes are a key part of a financial plan, and knowing how to truly understand them and some of the key insights that they provide will really help to gain a deeper understanding of a financial plan for those that you're working on. And so today we're going to be highlighting a specific case study on a pre-retiree. We're going to be highlighting some of the settings and assumptions that impact tax estimate and tax calculation. So some of the things that we're going to be looking at to ensure that you're aligning everything in RightCapital to your beliefs, and also tailoring it to the unique client situation, especially for tax calculations. It can be a very unique thing it's pretty in tune with the individual client scenario. We're also going to be highlighting that pre-retiree case study and what it looks like for that sample client plan of that tax module. And we're really going to dive deep into some of those schedules and what kind of insights we can gather from looking at those specific schedules and looking at the 1040 from each year. And we're also going to look at all the different insights from the tax credits and deductions and how to capture some of those things that are pretty key to make sure that we're accurately capturing tax calculations in the system. We're going to be highlighting all of that fun stuff and really diving deep into it. So we've got a lot of content to cover today. And of course, if you have questions, please feel free to navigate to the questions section and just input your questions there in the go-to control panel. More than happy to answer any questions you might have. Just to note, this is going to be recorded, so we will be able to view this. If you guys aren't taking notes throughout, no worries. You can always view and watch the recording after this presentation is done. So a lot of stuff we're going to be diving into today, and shifting gears into RightCapital. The first thing that we want to address in RightCapital is when you log into your RightCapital portal, the first thing you're going to see is your client list. But very importantly, and a key thing when we're looking at tax calculations and some of the considerations that play a role in how we're calculating taxes and portfolio return, things like that, is going to be featured under the Assumptions tab. Here under Assumptions, this is where you can indicate what you're utilizing for asset returns. So this is a key thing to make sure that this is aligned for what you want to run with on the global level standard for your asset returns. You can indicate here what you're using for that percentage of total return for each asset class that is going to be made up of, interest. So for government bonds, for example, you can indicate what you're using for an interest calculation for that specific return. You can specify dividend percentage and the capital gains that's applicable for each of the different asset classes. You can specify that if you didn't want to use one of the pre-filled studies. You can utilize the customized returns, and you can manually enter what you're using for total returns for each asset class and specify, like I said, for interest, dividends, and capital gains where applicable. But you can certainly utilize the historical index returns, which is going to look at the past 50 years of indice data where applicable, or the forward-looking assumptions based off of JP Morgan study, both reviewed annually and updated as necessary. So it's important to make sure that this aligns with that belief of what you want to run with, as when we're looking at calculating portfolio return and things along those lines and what makes up dividend calculation versus interest calculation and capital gains, that's all going to be tied back to what you're running with for your return assumptions. So it's very important that we have this set to what you want to run with on that global level scale. And once you get these assumptions set to how you want to indicate them, if we just open up our sample client plan, today we're going to be looking at the Halpert family. Some additional things that we want to ensure are set up how we want it to be for this particular client plan is, as I mentioned earlier, when you're in the advisor portal under assumptions, you're setting that global level of standard. When we're in an individual client plan, if we navigate to the gear icon settings section, you can specify under return assumptions that you want to use something other than your global level assumptions. So for example, if for this client, if they have a unique return assumptions that you wanted to apply, you can enter customized assumptions for this particular client plan, or forward-looking assumptions, which I'm not using right now for my global level standard, you can also apply. So you can modify this and adapt it to the unique individual client plan. When you're in that client plan, once again, you'd go to gear icon, settings, and return assumptions, and you're only modifying this particular client's plan settings when we're in an individual client plan. Another key thing that we want to make sure that we're highlighting and setting up how you want it to be truly aligned within the system is also going to be under the gear icon settings section. If we go into tax assumptions, some of the key things that you can apply within the system is you can specify what sort of tax law you want to utilize. So in the tax assumption, some of the things that we can address is that tax law setting. Right now using TCJA Sunset 2025, which means that we're going to be following that Tax Cuts Jobs Act. That's going to be assumed to be sunsetting in 2025, meaning we're going to be transitioning back to those pre-2017 tax brackets in 2026. You do have the option to change this. So if you wanted to run with the assumption that there's not going to be a sunset, that we're going to continue on with the current tax brackets, you can set it to TCJA, no sunset. Or if you wanted to make the transition now and assume that we're going to be looking at the 2017 tax law, you can change that. And that is going to have a direct impact upon the tax calculations when we're looking at future projections over the next couple of years. So it's important that if you didn't want to run with that assumption of TCJA Sunset 2025, you can come in here and specify what you want to run with and what you want to have as that assumption for this particular client plan. This is also a great place to look to see what we're running with in terms of the assumption for qualified dividends. So it's going to be that percentage of dividends which are assumed to be tax qualified. The remainder of dividend calculations are going to be assumed to be non-qualified. So kind of tying back into those return assumptions, how much we're actually calculating as dividends and what you want to see reflected as the percentage of qualified versus non-qualified dividends. You can control that calculation here. Right now we're using 85% to be assumed as qualified dividends. Another key thing that it's important to understand when we're looking at the tax calculations in RightCapital is there is going to be assumed portfolio turnover in the system for taxable accounts. A great thing too is you can always find these info marks. So when in doubt, if you need a little refresher, you can always hover over these info marks and it'll provide a little bit of a background as to what this particular item is referring to. So the portfolio turnover is going to be applicable towards those taxable accounts. Right now running with the assumption of 5%. So this is going to be a key thing to consider when we're looking at the 1040 and we're seeing that there's capital gains. That can be an indicator that there's portfolio turnover happening. And also we need to consider what's happening with the cost basis for an account, which we're going to cover a little bit later. And another important thing that you can cover here too, similar to the qualified dividends, is that you can specify what you want to run with as the assumption for what is going to fall under long-term capital gains versus short-term capital gains. So this is referring to that idea of when we're having return specifically, portfolio return, what's going to be long-term versus short-term capital gains. A lot of it, when we're looking at specific accounts, you're going to see when you're doing data entry for things like properties or assets, you're going to enter that purchase price and then the year of sale. The purchase price does play a role into that sort of capital gain calculation. So it's going to be a separate entry. This is referring to the long-term capital gains and what we're going to assume is long-term capital gains versus short-term capital gains elsewhere. Another key thing to consider is that you can enter any carryover values from previous years. So if we had a capital loss carryover that's applicable, or if we have any charitable giving carryover for cash or appreciated assets, you can enter it here to be considered in tax calculations moving forward. And the same thing with AMT or alternative minimum tax credit carry forward. You can specify that information and that'll be utilized when we're projecting any sorts of deductions or anything like that within the system. The other thing that you can also specify within the system is when applicable, you can specify the prior year's MAGI. So this is particularly impactful if we have something like Medicare premiums that we're calculating in the system. If somebody's already filing for Medicare and you wanted to make sure that we're calculating the proper 2-year look back, you can specify MAGI from last year and MAGI from 2 years ago to account for that. This is also vital when we're looking at things like student loan calculations, and if we're doing any sort of IBR approach, important to make sure that we're filling this out as applicable. So you do have that level of functionality available to you where you can specify that additional information to make sure that we're fully capturing the picture and getting the full current plan's picture for tax calculation purposes. Some of the other things that we want to consider when we're looking at the tax calculations and really how to make sure that it's fine-tuned to the individual client plan is if we go into the profile section and if we go into expenses, a key thing when we have a financial plan is that you can control what the filing status is for the clients. Within the taxes and fees card here, you can specify the filing status. So if we have a client and co-client, you can specify if they're married filing jointly, if they're married filing separately, or if they're not married and they're filing single. It's important to note this information because if they're not married filing jointly, their standard deductions are going to look very different and there's going to be other sorts of tax implications as a result. If we had just a single client, you can choose to indicate if they're just filing a single or as head of household. Another thing that can be entered within this tax and fees card that you can apply to this client plan is you can apply a local tax. So this is really applicable for if we have a client living in a large municipal city, so like New York City, for example, does have a local tax. You can account for it by entering it into this card. One thing to note is that we do apply state tax calculations separately. So this is only applicable if we have a local tax on top of those state tax calculations. And a good thing to note, because I already see this as a question, to make sure that we're accounting for the proper state tax calculations, if you go to Profile Family and under the client card, this is where you specify the state of residency. So if they're not living in Pennsylvania, you want to make sure that you're indicating here which state that they are living in to account for proper state tax calculations. So it's a great question. And then another key thing, so once you kind of go over those assumptions and make sure that we're entering everything accurately and make sure it aligns with your beliefs for this client plan, if we navigate into the tax module and then under tax estimate, this is where we can see some key insights and we can see under detail specifically some of the 1040s and various schedules that are applicable. But just to provide you guys with some background for the Halpert family plan, the Halpert family plan, they currently have a net worth of 1.6 million, including their primary home. They do have a child and they're in their mid-50s, they're pre-retirees. And they do have a combined income of 160,000 plus 125 each. And we are accounting for some bonus income for Jim, and they are pretty active in savings. They do have active living expenses of $7,000 a month with some health care premiums that they're paying for as well at $150 per month. So just some background as to where they stand. Mid-50s, they do have a child under the age of 18 that they are looking at funding college goals for in the future as well. Some of the key things, before we really dive deep into the tax estimate detail section, you can see some key insights here. But one of the greatest places to go in RightCapital to make sure we're fully understanding the financial well-being for the Halperts is if we navigate into the retirement module and into cash flows specifically. And then under summary, this is a good place to see the year-by-year breakdown of their inflows and their outflows and what is happening with their financial plan. This is a good place to see that high-level view, but you can also click into each individual header to view a further breakdown. So for example, with the tax payment, we can see a breakdown of federal, state, and FICA taxation. So if we wanted to see the breakdown of what is being considered in FICA tax calculations, you can click into that header. And as you can see, it's going to list it out for you. The same is true for state tax calculations. You can see what's leading to that state tax calculation in terms of taxable income. But you can also click into that federal level. So here under federal, this is a good place to look to see and kind of catch if we think that those taxes are a little bit too high for what we know is true for the financial plan. It's a key indicator that maybe something might need to be added or changed if it's not looking to be an accurate tax payment calculation. So for example, the $75,000 for this plan looks a little high for me for the helpers. It doesn't look similar to what their current tax payments are. Clicking into the federal level, it does look like we've got some pretty high AGI and taxable income. So some of the things that we can consider when we look at this high level approach, you can gauge what's happening each year in terms of income inflows, what's salary versus Social Security in the future, and then what's happening with expenses, seeing that we do have some healthcare costs that are occurring, so that's going to be a nice deduction. But since I'm seeing that this is a little high, let's take a look in the tax module, and then under tax estimate, and then specifically details. Here we can see that 1040 for this year. You can choose to view other years out through the entire projection of their lifetime, but let's focus on this year. You can see that breakdown of what's happening for standard deduction. And this is why it's important to make sure that we're accurately capturing that tax filing status, as there are different deductions, of course, for each different filing status, if they're married filing jointly, married filing separately, or not married filing single. A key thing to note too is that within the system, we will take the higher of. So if they have extremely high itemized deductions, we would take that higher number, versus if the standard deduction is higher than that itemized deductions, we're going to take the standard deduction. So all that's going to be considered and already playing a role when we're looking at this deduction figure. And so as we can see, they do have some pretty high capital gains of $25,438. This is a good place to look and say, this isn't really true to what I know that their capital gains should look like this year. So some things that are playing a role here is that we do have that portfolio turnover that's accounted for of 5%. That's going to play a role. But this should be a key indicator that maybe something is missing in terms of cost basis somewhere. So let's navigate to the profile section. And then under net worth, I do know that they have a brokerage account, so let's see what's entered there. And so as we can see, there's no cost basis entered. So that's going to result in a pretty large capital gain taxation. So just for an example, if we change this cost basis and entered what the true cost basis is, we're going to see an impact when we're looking back in tax estimate details. As you can see, that capital gains is going to adjust accordingly now that we've reduced that gap in terms of cost basis versus account value today. It's going to be a little bit more of an accurate projection. And so for their plan, we also are considering that portfolio turnover. But as we saw before, when we went back in retirement cash flows, they did also have a negative net flow. And so within the system, if we go to retirement cash flows summary, we can see they've got a negative net flow. And my assumption is that I'm going to be pulling from the taxable accounts first, and then tax deferred, and then tax free. So as a result of them pulling from the taxable account, they are going to be, if we don't have cost basis, could be subject to some capital gains there. So it's important we're accurately capturing that sort of information, especially for taxable brokerage accounts. Some additional things that we can view here in the 1040 is you can see, of course, what's leading towards the total tax rate or total tax of the year, but some things that are going to be assumed when we have a financial plan. So with the helpers, they do have a child that is under the age of 18. They're planning to go on to college in the future, so that's going to be a different conversation in a couple of years, but they do have someone that's under 16. The system will automatically account for any sort of applicable child tax credits if we do have the children entered accurately in the system. So as we can see, we're going to be accounting for that child tax credit. But we can also look at these various schedules. So if we looked at schedule 1 through 3, we can see some of those additional income and adjustments to income and what's leading towards any sort of calculations on this. You can see any additional credits and payments. We can see any sort of additional taxes. So if we had any AMTs playing a role, we'd see that also located here, and see a lot of vital information in terms of net investment income tax. and any non-refundable credits that are occurring. It's a good place to see some insight. So if you're seeing a credit and we weren't sure exactly where it's coming from, good place to view here some additional credits and payments. We can also view Schedule A, so looking at itemized deductions. So like I said, if we have higher itemized deductions, so let's say itemized deductions were, 40,000, we're going to take the higher of itemized deductions versus the standard deduction, if applicable. So we can see what's going into the itemized deduction calculation and considerations. As I said, we've got those medical expenses that are occurring. We have the taxes you paid, interest you paid, any gifts to charity, and then your total itemized deduction amount for the year. As we can see, it is lower than the standard deduction for somebody that's married filing jointly. So we're going to take that higher of standard deduction as a result. This is also a key place to note, if we see there's no gifts to charity, this is a key indicator. I know that the helpers actually did make a charitable contribution. So let's make sure that we're entering that accurately. If we wanted to account for that entry, we'd want to go back in a profile, goals. And if we go to add goal, we can go to gift and then charitable giving. And then with this card, we can indicate how much they plan on contributing towards the charity each year. And so for them, they make a charitable giving goal of $15,000 per year, jointly owned. And then you can choose if it's an annual dollar amount for the gift type or if they choose to donate a percentage of their income. And you can choose which asset they're pulling from. So this is very important to specify. If you did have somebody with a donor advised fund that they've created in the net worth section, for example, you can specify that we're using a DAF, or if it's coming from an appreciated asset, you can specify that. In this instance, they're donating cash, and then the recipient is going to be a charity, but this is also how you can indicate money going towards a donor advised fund. And so we can indicate that this did start in 2023. And then key thing is indicating the frequency at which they're making these contributions. So they're going to be making it every 2 years. And when we select that option, we can then indicate when this goal is going to end. So for this scenario, the helpers, they plan on making this contribution until Jim's retirement. And there's going to be no increase to this charitable giving goal. It's going to be a flat 15,000. So we want to make sure we're changing the annual increase from general inflation to no inflation. And so then when we hit save, we'll now see an impact because we're going to be considering that charity gift back in tax estimate. And then under details, if we go back into Schedule A, we can see that breakdown once again. We can see that that gift to charity is considered. And now we see that itemized deduction is $28,169, which is going to be higher than the standard deduction. So now we're going to see 12A reflected their true itemized deduction. And so that's a key thing too when we're looking here. If you know that they're going to be taking a higher amount than the standard deduction, it's a key thing to note, there could be charitable giving goals missing, or maybe there's some deductions that aren't entered, maybe a medical premium or a healthcare premium that wasn't entered. It's a key place to get that kind of insight to ensure that we're entering everything as accurately as possible, as everything that we're seeing here is all based off of what we've entered for their financial plan. On top of seeing Schedule A, we can also look at Schedule B, which is going to look at the calculations behind interest and ordinary dividends. You can see here what's going to be falling under the interest amount, what's going to fall under ordinary dividends, and so on and so forth. And the same thing too for Schedule D. You can see a breakdown of capital gains and losses. And so this is also a great place to go to if you see on the schedule or on the 1040 that there is a high capital gains amount. You can always revert to the Schedule D and see a breakdown of what is leading towards the capital gains and losses calculation. So you can see here, what's happening in terms of short terms, long-term capital gains, and then you can see that nice summary and the end result. And so this is important, you know, if you've got things like a lot of asset sales, that's going to result in long-term capital gains or short-term capital gains. You can see here some of those insights as to what's happening in those years. We can also view the alternative minimum tax form or the AMT form. So if you've got things like stock plans that you're accounting for, things like ISOs that are going to result in an AMT, you can view this form to see, you know, what's going to be leading towards any sort of alternative minimum tax. So it's a very detailed form here in terms of summarizing those numbers. And the same thing too, you can also view the taxable Social Security form and what's leading towards that taxable Social Security. It's going to be more applicable. They're not filing for Social Security yet. So let's go a little bit further in their span. And you can see what's happening in terms of the taxable Social Security calculation. So some great insights here. And we can, of course, choose different years and view the 1040s and the other schedules based on that year. You can see the difference in terms of, you know, capital gains, what's happening in terms of income. They're no longer receiving salary at this point in time. They're retired in 2055. And you can see what's happening in terms of interest and dividend calculations. You can see those distributions that are occurring. So any RMDs and any sort of calculations in terms of tax calculations as a result of RMDs can be viewed here. We can also view those taxable Social Security benefits as well. See that, you know, total tax at the very bottom and the taxable income versus the tax. So a lot of great insights can be viewed here. If we navigate back into the retirement module and then into cash flows, this is a great place to also come back and just make sure that everything is appearing in each year as you want it to. So it's a good place, like I said, to catch where a lot of the tax payments fluctuate. You can see, you know, we do have a home sale when they retire. When Jim retires, they're selling their primary home in 2039. And then they're going to be downsizing and purchasing a smaller property at that point in time. So there is going to be a different sort of tax calculation we're accounting for there. And then you can see that drop when they're both retired. And then we can see RMDs kick on. And a key thing too is that when we're looking at specifically analyzing a different proposed scenario, so let's say we did have a proposed plan, which I do have a slightly different proposed plan, you're going to see variances in terms of tax calculations. A key thing to note, you know, just to give you guys some background in retirement analysis, my proposed plan, I have them retiring slightly earlier, an increased salary and bonus, and I have them saving more aggressively. So that's going to be the difference in my proposed plan, just to provide some background there. So I do already have a proposed plan built out. When we're looking at the tax estimate detail section, you can choose to view the proposed plan versus current plan. So you can see the breakdown of either your current plan or any proposed scenario, especially important if you're looking to model and compare different situations and you still wanted to see the background projection details of the tax forms. You do have that option to select each individual proposed scenario or current plan. Looking in the estimate tab here, this is where you can view a nice chart visualization of things like their effective tax rate. So this will highlight, you know, the federal tax rate, the state tax rate, FICA, and also if applicable, and you entered any local tax rate for this client plan, you would see that listed here. And you can view the federal income tax brackets that they're falling into from this chart as well. And you can see those fluctuations, you know, as we're retiring, RMDs kick on, things like that. And then you can also view the federal capital gains tax bracket visualization over their plan. And this is something that can also be toggled between multiple proposed scenarios as well. So if you wanted to see the difference between multiple scenarios, this is how you can do so. Another key thing was when you're really trying to compare one plan versus another and the specifically tax calculations and the tax difference. When we go to the retirement module and then under analysis, if we go into comparisons, this is where you can see a really powerful chart If we change the scenario analysis drop down to taxes, you can view a side-by-side comparison of whether your proposed plan has more in total taxes versus a current plan. So this is very useful for any conversations you're having where you're comparing different situations, maybe such as Roth conversions, which is going to have potential impacts to tax calculations. You can view that difference between our proposed plan, you know, where I have him in the scenario retiring earlier, earning more income, but saving more aggressively and spending a little bit less. With this scenario, they do have a little bit more in total taxes. So it's a pretty powerful visual backdrop for any conversations you're having and comparing two scenarios, specifically focusing on the tax calculations.